In this lecture, we'll explore the specific objectives of the completion phase and the essential steps that remain before an auditor can confidently sign off on the audit engagement. This phase is not just about tying up loose ends, but is a final and comprehensive evaluation of the audit evidence gathered throughout the engagement. As auditors, your responsibility is to ensure that financial statements present a true and fair view of the entity's financial position, performance, and cash flows. To date, we have navigated through planning, risk assessment, test of controls, and substantive testing. And now we are at the phase of concluding the audit of the financial statements. The completion phase represents the culmination of diligent efforts and critical analysis as we prepare to deliver assurance on the accuracy and reliability of financial information. As such, the completion phase is the bridge between evidence gathering and delivering the auditor's opinion. We'll discuss the critical tasks involved in the completion phase, including the review and assessment of final audit adjustments, subsequent events, and the overall financial statement presentation. We'll also touch upon the evaluation of the management representations, the documentation process, and the crucial role of professional skepticism in this final stretch of the audit journey. Furthermore, we'll emphasize the significance of communication with management and those charged with governance during the completion phase. Clear and transparent communication is paramount in addressing any outstanding issues, obtaining necessary representations, and ultimately ensuring a smooth conclusion to the audit process. The audit process involves a series of systematic and interrelated activities, and the timeline for these activities can be broken down into several key phases. Before the client's year-end, interim audit procedures may be performed. These procedures aim to address certain audit objectives and risks early in the process, providing the auditor with timely information and potentially improving the efficiency of the overall audit. Performing interim audit procedures is a strategic decision that depends on factors such as the nature of the client's business, the complexity of transactions, and the audit risk assessment. It allows auditors to identify issues early, respond to emerging risks promptly, and ultimately contribute to a more efficient and effective audit process. Interim procedures may include performing risk assessment procedures to identify and understand key risk areas, industry trends, and changes in the client's business environment. This allows auditors to tailor their audit plan based on the specific risk associated with the client. Also, in certain situations, substantive testing may be conducted on an interim basis. This is common when the client's business has consistent operations throughout the year, and it allows auditors to distribute the workload more evenly. If reliance on internal controls is a significant component of the audit strategy, auditors may perform interim testing of controls to gain assurance on their operating effectiveness. This early assessment helps auditors identify control deficiencies and plan their substantive procedures accordingly. After the client's year-end and before signing off on the audit, auditors gather audit evidence to support the financial statement assertions by conducting substantive audit procedures, which include substantive tests of transactions and testing account balances and assertions, and assessing the impact of management's estimates and judgments. Based on the results of substantive tests, auditors identify and evaluate any necessary year-end adjustments. After year-end, auditors also evaluate going concern issues if applicable, obtain management representations and written confirmations, and review subsequent events that may impact financial statements. After the audit report date, there are several activities that occur leading up to and after the release of the audit report. The audit report date is the date on which the auditor has obtained sufficient appropriate audit evidence to support their opinion and concludes that the financial statements are presented fairly in accordance with applicable financial reporting framework. Once all necessary procedures are completed and any outstanding issues are resolved, the audit report is issued. The report provides the auditor's opinion on whether the financial statements present a true and fair view in accordance with the applicable financial reporting framework. Major activities that follow the audit report date include subsequent discovered facts, which refer to events or conditions that come to the auditor's attention after the audit report date. These events or facts can have a significant impact on the financial statements, and the auditor must evaluate their implications. Communication of any significant findings or issues identified during the audit to those charged with governance. This communication may include discussions about the financial statements, audit procedures performed, and the auditor's opinion. Issuance of the management letter, which is a communication from the auditor to the client. Unlike the audit report, which is addressed to the users of the financial statements, the management letter is specifically directed to the client's management and governance. For example, the management letter may highlight weaknesses or deficiencies identified in the client's internal control systems during the audit. The purpose is to provide constructive feedback and recommendations for improvement. Analytical procedures are an essential component of the audit process, performed during both the planning and completion phases. While analytical procedures during the planning phase help auditors gain an understanding of the client's business and assess risks, those performed during the completion phase serve a different set of objectives. For example, during the completion phase of the audit, auditors may perform analytical procedures as a final review of the financial statements. Auditors compare the final set of financial statements against expectations based on their understanding of the entity and industry, as well as the results of their substantive procedures. Analytical procedures at this phase can also be performed to corroborate substantive testing results. If substantive procedures identified certain risks or issues, analytical procedures help auditors validate that those concerns have been appropriately addressed in the financial statements. Additionally, the completion phase analytical procedures contribute to the auditor's final assessment of overall audit conclusions. They play a role in forming the basis for the auditor's opinion on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework. In summary, analytical procedures during the completion phase of an audit serve as a critical tool for auditors to finalize their evaluation of the financial statements. These procedures help ensure that the financial statement information is consistent, plausible, and free from material misstatements, providing assurances about the reliability of the financial reporting process. Accounting estimates are monetary amounts that are not precisely determinable but are necessary for the preparation of financial statements. They involve subjective judgment and are based on the interpretation of available information. Companies make accounting estimates when they encounter uncertainties related to future events. Some examples of accounting estimates include the allowance for bad debts. Companies estimate the amount of receivables that may not be collectible based on historical experience, industry trends, and economic conditions. The fair value of certain investments, especially those not actively traded in the market, also requires estimation. Methods such as discounted cash flow analysis may be used. Companies also estimate the future costs associated with fulfilling warranty obligations based on historical warranty claims and other relevant factors. Accruals related to legal settlements also involve estimation, taking into account the likelihood of an unfavorable outcome and the potential financial impact. Determining the provision for income taxes involves estimating current and deferred tax liabilities based on the applicable tax rates and regulations. The audit of accounting estimates is challenging due to their inherent subjectivity and reliance on management judgment. As such, the audit of accounting estimates requires a thoughtful and thorough approach, balancing professional skepticism with the need to understand the complexities involved in the estimation process. To ensure the reasonableness and reliability of these estimates, auditors are required to gain a thorough understanding of the methods used by management to develop accounting estimates and assess the reasonableness of those methods. Auditors should engage in discussions with management to understand the assumptions and methods used in making accounting estimates. This includes inquiring about changes from previous periods and the reasons behind them. Auditors should assess the process followed by management in developing accounting estimates, including the data used, significant assumptions, and methodologies employed. In some cases, auditors may need to involve specialists such as valuation experts or actuaries to assist in evaluating specific accounting estimates. Also, in some cases, auditors may develop independent estimates of certain accounting estimates to compare them with management's estimates. This can provide additional assurance on reasonableness. Due to the subjective, uncertain nature of accounting estimates, it may be difficult for auditors to resolve differences over accounting estimates with clients. In the resolution of these accounting estimates, auditors can potentially impact their independence, professional skepticism, and overall audit quality. For example, in the resolution of accounting estimates, auditors may face pressure from the client to align their conclusions with a desired financial reporting outcome. This pressure could come from the client's management or those charged with governance who may have a vested interest in the financial results. Auditors may be required to rely on management representations regarding the reasonableness of estimates and assumptions. Over-reliance on management without sufficient corroboration or independent verification can undermine professional skepticism. Auditors might accept management's assertions without subjecting them to rigorous questioning or testing. This lack of skepticism can result in auditors overlooking potential biases or inaccuracies in management's estimates. If auditors are not sufficiently skeptical during the resolution of accounting estimates, there's a risk of failing to identify management biases or manipulation in the estimation process. This can lead to the acceptance of estimates that do not reflect the economic substance of the transactions or events. To mitigate these risks, auditors must prioritize independence, maintain a healthy level of professional skepticism, and diligently apply rigorous audit procedures during the resolution of accounting estimates. This involves challenging management's assumptions, independently verifying data, and thoroughly documenting the audit process. Proactive communication with those charged with governance and adherence to professional standards contribute to the preservation of auditor independence and the enhancement of overall audit quality. Contingent liabilities are potential obligations that may or may not become actual liabilities depending on the occurrence or non-occurrence of future events. These obligations arise from past events, but their existence is uncertain, contingent upon the outcome of uncertain future events. Contingent liabilities are disclosed in the notes to the financial statements unless the possibility of an outflow of resources is remote. They are important for financial statement users to understand potential future financial obligations that a company may face. Some examples of contingent liabilities include pending legal actions where the outcome is uncertain can result in contingent liabilities. The company might disclose potential legal claims and estimate the potential financial impact. Product warranty claims on products sold by the company represent contingent liabilities. The actual amount depends on the number of claims and the nature of the warranty coverage. Guarantees for loans or other obligations of third parties create contingent liabilities. If the debtor defaults, the company may be required to fulfill the guarantee. Disputes with tax authorities that may result in additional tax liabilities are also examples of contingent liabilities. The outcome depends on the resolution of the dispute. Auditors have specific responsibilities related to contingent liabilities as part of their audit procedures. Auditors need to gain an understanding of the client's business and industry to identify potential contingent liabilities. This involves discussions with management, reviewing legal correspondence, and examining contracts and agreements. Auditors are required to inquire with management about the existence of contingent liabilities, which includes discussions about the nature, likelihood, and potential financial impact of such obligations. Auditors also obtain legal confirmation directly from the client's legal counsel to assess the likelihood of pending legal actions and the potential financial implications. The review of minutes of meetings and contracts can provide insights into potential contingent liabilities, especially those arising from guarantees, indemnifications, or other contractual obligations. Auditors perform procedures to corroborate information provided by management regarding contingent liabilities. This may involve obtaining third-party confirmation or contacting external legal experts. If contingent liabilities involve estimates such as those related to legal claims or warranty obligations, auditors assess the reasonableness of management's estimates and consider the sensitivity of these estimates to changes in assumptions. Auditors review subsequent events up to the date of the audit report to identify any developments that may impact the assessment of contingent liabilities. This includes events that may confirm or change the likelihood of the contingencies. The audit of contingent liabilities requires a thorough understanding of the client's business, effective communication with management and legal counsel, and careful consideration of the likelihood and potential financial impact of contingent obligations. Auditors must exercise professional judgment and maintain a skeptical attitude to ensure that financial statement users are appropriately informed about potential future financial obligations. The inquiry of a client's attorneys is a crucial step in the audit process, particularly when dealing with legal matters and contingent liabilities. It involves auditors reaching out to the legal counsel representing the client to obtain information and insights that are relevant to the audit. This inquiry helps auditors assess the legal aspects of the client's operations, potential contingencies, and any pending or threatened litigation that could impact the financial statements. An attorney letter, also known as a lawyer representation letter or attorney representation letter, is a written communication from the client's legal counsel to the auditors. This letter is typically requested by the auditors as a part of their audit procedures, and it serves as a means of obtaining information directly from the legal professionals involved in representing the client. Attorney letters are used to corroborate and provide additional evidence regarding legal matters that may have financial implications for the client. The attorney letter generally includes various representations and information provided by the client's legal counsel. While the specific contents may vary based on the nature of the engagement and the legal issues involved, attorney letters typically cover the following key areas: confirmation of the existence of any pending, threatened, or potential litigation, claims or assessments that may have a material impact on the financial statements, disclosure of any unasserted claims or assessments that the attorney is aware of, which, if asserted, could have a material impact on the financial statements, information on contingent liabilities that may arise from legal matters, including estimates of potential losses, if applicable, the attorney's professional opinion on the likelihood of success or failure in pending or threatened legal matters, as well as the potential range of outcomes. It's important to note that while attorneys' letters provide valuable information, auditors do not solely rely on these letters. They use attorney letters in conjunction with other audit procedures, such as review of legal correspondence, assessment of litigation-related documentation, and discussions with management to form a comprehensive understanding of the legal landscape surrounding the client's operations. Auditors must evaluate events occurring after the balance sheet date and consider the implications on the financial statements. There are two types of subsequent events that auditors consider. There are subsequent events that occur between the date of the financial statements and the date of the auditor's report, and subsequently discovered facts, which become known after the date of the auditor's report. Subsequent events can have a significant impact on the financial statements and may require adjustments or additional disclosures, are classified into two main types, Type 1 and Type 2. Type 1 subsequent events are those that provide additional evidence about conditions that existed at the date of the financial statements. When auditors become aware of Type 1 subsequent events, they need to evaluate whether these events affect the estimates used in the financial statements or confirm conditions that existed at the balance sheet date. For example, suppose a company prepares its financial statements as of December 31st, reporting an accounts receivable balance of $1 million. After the year end, the company's major customer declares bankruptcy in January. If the auditor becomes aware of this bankruptcy before issuing the audit report, it's a Type 1 subsequent event. The bankruptcy confirms a condition, financial distress, that existed at the balance sheet date and the financial statements may need adjustment or additional disclosure. In contrast, Type 2 subsequent events are those that are indicative of conditions that arose after the date of the financial statements. These events were not present at the balance sheet date and may require disclosure in the financial statements. For example, suppose a manufacturing company completes its financial statements as of December 31st, reporting inventory at a cost of $2 million. After the financial statements are prepared, but before they are issued, a fire breaks out in the company's warehouse in January, resulting in significant damage to the inventory. In this scenario, the fire is a Type 2 subsequent event because it occurred after the balance sheet date. Since the fire is indicative of conditions that arose after December 31st, the financial statements may not reflect this event. As a Type 2 subsequent event, the auditors need to consider whether disclosure in the financial statements is necessary to provide users with relevant information about the impact of the fire on the company's financial position. Auditors would need to assess the materiality of the fire's impact on the financial statements and ensure that appropriate disclosures are made if the event is deemed to be significant. This may include disclosing the extent of the damage, any insurance coverage, and the potential financial consequences for the company. The key distinction for Type 2 subsequent events is that they are events that occurred after the balance sheet date and therefore were not considered in the preparation of the financial statements. Auditors play a critical role in identifying and evaluating such events to ensure that financial statement users are informed of significant developments that may impact the company's financial position after the close of the reporting period. The handling of subsequently discovered facts depends significantly on whether they are identified before or after the audit report release date. The timing of discovery has a crucial impact on the auditor's responsibility and the actions that need to be taken. If subsequently discovered facts are identified before the audit report is released, the auditor has a responsibility to evaluate the materiality and relevance of these facts to the financial statements. If the subsequently discovered facts are material and affect the financial statements, the auditor may need to work with management to make appropriate adjustments. These adjustments could include revising the financial statements, making necessary disclosures, or providing additional information to ensure the accuracy and completeness of the financial reporting. The auditor must communicate the subsequently discovered facts to those charged with governance. This communication involves discussing the nature and impact of the facts, potential adjustments, and the implications for the audit report. Depending on the significance of the subsequently discovered facts, the auditor may need to issue a revised auditor's report. The revision could involve modifying the opinion or adding an emphasis of matter paragraph to draw attention to the matter. If subsequently discovered facts are identified after the audit report is released, the auditor's responsibility remains, but the actions and options available are more limited. The auditor must assess the materiality and significance of the subsequently discovered facts. If the facts are material, the auditor should communicate them promptly to those charged with governance and management. In cases where the subsequently discovered facts are so material that the financial statements are no longer reliable, there may be a need to issue revised financial statements. However, issuing revised financial statements is a serious matter and should be approached cautiously. The auditor needs to consider legal and ethical obligations regarding the communication of subsequently discovered facts. In some jurisdictions, there may be reporting requirements to regulatory authorities. If revised financial statements are issued, the auditor may need to issue a revised auditor's report. The revision would typically include a reference to the fact that the financial statements have been restated and the reasons for the restatement. In summary, the timing of discovery significantly impacts the auditor's options and responsibilities. If subsequently discovered facts are identified before the audit report release date, there is more flexibility to address and rectify the issues, potentially through adjustments to the financial statements. However, if the facts are discovered after the release date, the auditor's options are more constrained and the process of revising financial statements and audit reports become more complex and significant. In both cases, transparency and clear communication with stakeholders are essential to maintaining trust and integrity in the financial reporting process. Auditors perform various procedures during the subsequent events review to ensure that events occurring between the date of the financial statements and the date of the auditor's report are appropriately considered. These procedures help auditors identify and evaluate subsequent events that may impact the financial statements. For example, auditors inquire with management about events that occurred after the balance sheet date. They may also obtain confirmations from third parties such as legal counsel or key customers to corroborate the information. They review the minutes of meetings held after the balance sheet date and significant contracts entered into or modified subsequent to the balance sheet date. This helps identify events or transactions that may have occurred. Auditors may read subsequent period financial statements, interim financial reports, or other financial information to identify events or transactions that provide additional information about conditions that existed at the balance sheet date. Auditors may inquire about any legal proceedings, claims, or assessments that have arisen after the balance sheet date. Attorney letters may be requested to obtain direct confirmation from legal counsel regarding the status of legal matters. Analytical procedures involve reviewing financial data for unexpected fluctuations or trend that may indicate the occurrence of subsequent events. This may include comparing actual financial results with budgeted or prior period results. Auditors may review contracts and agreements entered into after the balance sheet date to identify any material transactions or commitments that have a bearing on the financial statements. Continuous communication with management and those charged with governance helps auditors stay informed about events or circumstances that may impact the financial statements and may lead to additional inquiries or procedures. Auditors may also consider information from external sources, such as industry publications, news articles, or regulatory filings to identify events or developments that could impact the client's financial position. Auditors evaluate the procedures performed by management to identify subsequent events. This involves assessing the completeness and accuracy of management's subsequent events review process. These examples of audit procedures are essential for providing reasonable assurance that subsequent events are appropriately considered and disclosed in the financial statements. Auditors use their professional judgment to determine the nature and extent of procedures based on the specific circumstances of the engagement. The goal is to ensure that financial statement users are provided with relevant and reliable information about events that may impact the company's financial position after the balance sheet date. Auditors identify any misstatements or errors in the financial statements that are material and need adjustment. These misstatements may relate to errors in recognition, measurement, presentation, or disclosure. Auditors communicate with management regarding identified misstatements. This communication allows for clarification of issues, discussions about the nature and impact of the misstatements, and agreement on necessary adjustments. Based on their assessment and discussions with management, auditors propose adjusting entries to correct the identified misstatements. Adjusting entries are formal recommendations for changes to specific accounts in the financial statements. The rollover and iron curtain methods are two approaches used by auditors to evaluate the materiality of the impact of adjustments on the financial statements. These methods help auditors assess whether the cumulative effect of uncorrected misstatements, if any, is material to the overall fairness of the financial statements. The rollover method evaluates the impact of misstatements by considering their effects on the current year's financial statements. It focuses on the individual misstatements and assesses whether they materially affect the current year's financial performance. Auditors calculate the effects of each uncorrected misstatement on the current year's financial statements. Each misstatement is evaluated independently to determine its materiality based on a predetermined threshold or benchmark. If the individual misstatements, when added together, are below the materiality threshold, auditors may conclude that the cumulative impact is not material and may not warrant correction. The rollover method tends to be more focused on the immediate impact of misstatements on the current year's financial results. It may not fully capture the potential cumulative impact over multiple periods. In contrast, the Iron Curtain method takes a more conservative approach by evaluating the aggregate impact of uncorrected misstatements on both the current and prior year's financial statements. It assumes that misstatements are ironed out over time and considers their cumulative effect. Auditors calculate the cumulative effects of uncorrected misstatements on the current year's financial statements. They then assess the impact of these cumulative misstatements on the prior year's financial statements. The Iron Curtain method sets a threshold for the cumulative impact on both the current and prior years, and if the total is below this threshold, auditors may consider the misstatements immaterial. The Iron Curtain method is more conservative as it considers the potential compounding effect of misstatements over time. It recognizes that errors in one period may carry forward and impact subsequent financial statements. Ultimately, the choice between the rollover and Iron Curtain methods depends on the specific circumstances of the audit engagement and the auditor's professional judgment. The goal is to ensure that the financial statements present a true and fair view of the entity's financial position and that material misstatements are appropriately addressed. Auditors are responsible for assessing whether the entity has the ability to operate for the foreseeable future, typically at least 1 year from the date of the financial statements. The going concern assessment has significant implications for financial statement users. Auditors start by gaining a deep understanding of the entity's business industry and operating environment. This involves considering factors such as economic conditions, industry trends, and regulatory requirements. Auditors perform a risk assessment to identify and assess risks that may affect the entity's ability to continue as a going concern. This includes evaluating internal and external factors that could impact the entity's financial health. Auditors conduct analytical procedures to assess key financial ratios, trends, and other indicators that may signal financial distress or going concern issues. These procedures involve comparing current and historical financial information and benchmarking against industry standards. Auditors inquire with management about the entity's plans, strategies, and assessments of its ability to continue as a going concern. Discussions may include considerations of capital raising, debt restructuring, or other measures to address financial challenges. Additionally, auditors may review the entity's financial forecasts and budgets to assess the reasonableness of assumptions and to evaluate whether these forecasts support the going concern assumption. This is particularly relevant if there are uncertainties about the entity's future cash flows. Auditors will also evaluate the terms of debt agreements and other contractual obligations to assess any potential breaches or defaults. This includes understanding the entity's ability to meet debt covenants and obligations as they become due. They may also consider mitigating factors that may support the going concern assumption, such as plans to raise capital, the existence of committed financing arrangements, or expected improvements in operating performance. Auditors evaluate the feasibility and effectiveness of management's plans to address any identified going concern issues. This involves assessing the likelihood of successful implementation and the impact of the entity's financial position. Throughout the process, auditors document their findings, assessments, and conclusions regarding the entity's ability to continue as a going concern. This documentation is essential for supporting the audit opinion and demonstrating compliance with auditing standards. Auditors must communicate with those charged with governance about their findings and the implications for the going concern assumption. This ensures transparency and allows for appropriate discussions and decisions. If auditors conclude that there is a material uncertainty related to the entity's ability to continue as a going concern, they include an emphasis of matter paragraph in the auditor's report. This paragraph highlights the issue and refers to the relevant note in the financial statements. Auditors will also review subsequent events up to the date of the auditor's report to identify any developments that may impact the going concern assessment. This includes events that may confirm or alleviate concerns about the entity's ability to continue as a going concern. It's important to note that if auditors have significant doubts about the entity's ability to continue as a going concern and believe the issue is not adequately disclosed in the financial statements, they may issue a qualified or adverse opinion. This underscores the seriousness of the matter and ensures that financial statement users are appropriately informed about the entity's financial health. The Management Representation Letter is a document that management provides to auditors during the course of an audit. It is a written statement from management to the auditors confirming various representations related to the financial statements and the conduct of the audit. The purpose of the Management Representation Letter is to obtain written confirmation from management about certain key matters and to establish a clear understanding between management and the auditor. The letter serves several important purposes, including confirming that management is responsible for the preparation and fair presentation of the financial statements in accordance with the applicable financial reporting framework. It emphasizes management's primary role in the financial reporting process. The letter represents that management has provided the auditors with all relevant information and that all significant transactions and events have been disclosed to the auditors. This helps ensure that the audit is conducted based on complete and accurate information. The letter includes specific assertions and representations from management regarding various aspects of the financial statements, such as the completeness and accuracy of information, adherence to accounting standards, and the absence of undisclosed liabilities. Management is required to disclose to the auditors any known or potential legal matters and contingent liabilities. The representation letter ensures that management has made appropriate disclosures related to legal proceedings, claims, or other contingencies. Management represents that it has disclosed to the auditors any significant deficiencies or material weaknesses in internal control over financial reporting. This is important for auditors to consider in their evaluation of the effectiveness of internal controls. The letter also includes management's representation about its assessment of the entity's ability to continue as a going concern. This is particularly important if there are uncertainties about the entity's financial viability. Management is required to inform the auditors about any known or suspected fraud or illegal acts that may have a material effect on the financial statements. The representation letter ensures that management has fulfilled this obligation. Management represents that it has disclosed all related party transactions to the auditor. This is important for the auditors to assess the potential impact of such transactions on the financial statements. Overall, the Management Representation Letter is a standard practice in the audit process, and it helps enhance the auditor's confidence in the reliability of the information provided by management. However, it's important to note that while a letter provides valuable assurances, auditors rely on a combination of evidence, including substantive procedures and other audit techniques, to form their conclusions and opinions on the financial statements. The representation letter is just one component of the overall audit process. In evaluating the results of the audit, auditors aim to ensure that the evidence collected is robust, relevant, and sufficient to support the conclusions drawn in the audit report. As the audit progresses, auditors conduct a final review of the evidence collected and assess whether it supports their planned audit procedures, addresses identified risk, and provides a basis for the audit opinion. Based on their evaluation of the evidence, auditors form an opinion on the fairness of the financial statements. If the evidence is deemed sufficient and appropriate, auditors express an unmodified opinion. If there are material misstatements, auditors modify their opinion accordingly. Financial statement disclosures provide additional context and details that complement the primary financial statements. Evaluating the disclosures ensures that they are accurate, complete, and in compliance with relevant accounting standards. Auditors begin by understanding the relevant accounting standards and disclosure requirements applicable to the entity's industry and specific circumstances. This understanding serves as the basis for evaluating whether the financial statements include all necessary disclosures. They will typically use a disclosure checklist that outlines the specific disclosures required by the accounting standards. The checklist serves as a guide to ensure that all necessary disclosures are considered and evaluated. Auditors assess whether all required disclosures have been included in the financial statements. This involves checking for the presence of disclosures related to accounting policies, significant accounting estimates, contingencies, related party transactions, and other relevant matters. Auditors ensure that disclosed accounting policies are consistent with those applied in the preparation of the financial statements. Any changes in accounting policies are appropriately disclosed and explained. They also evaluate the clarity and understandability of the disclosures. The language and presentation should be clear and comprehensible to users of the financial statements, including investors and other stakeholders. They also verify the accuracy and reliability of the information presented in the disclosures. This may involve cross-referencing information in the disclosures with supporting documentation and substantive testing procedures. Auditors review the footnotes and supporting schedules accompanying the financial statements. These often provide additional details, explanations, and breakdowns that enhance the understanding of the financial statements. They also assess the adequacy of disclosures related to contingencies, legal matters, and other uncertainties. This includes evaluating the completeness and appropriateness of the information provided regarding potential liabilities. Auditors communicate with management to clarify any uncertainties, seek additional information, or discuss the wording and presentation of certain disclosures. This collaboration helps ensure that the disclosures accurately reflect the entity's financial position and operations. The thorough evaluation of financial statement disclosures is essential for providing users of the financial statements with a comprehensive and accurate understanding of the entity's financial position and performance. It enhances transparency and helps stakeholders make informed decisions based on reliable and relevant information. The Audit Documentation Review is an internal quality control process where a designated reviewer, often a senior member of the audit team or an audit manager, assesses the completeness, accuracy, and compliance of the audit documentation. The objectives of the review are to ensure that the audit documentation supports the auditor's conclusions and the issuance of the audit report, to verify that the documentation complies with the firm's policies and procedures, and to identify any deficiencies or areas where additional information or clarification is needed. Key aspects of the audit documentation review include completeness. The reviewer checks whether all required documentation, including work papers, supporting schedules, and conclusions, is present. The reviewer assesses the accuracy of calculations, data, and conclusions presented in the documentation. The reviewer verifies that the documentation adheres to the firm's auditing standards, policies, and relevant regulatory requirements. The reviewer also ensures that there is appropriate cross-referencing between different sections of the audit documentation and that information is consistent. The reviewer communicates with the engagement team to address any identified deficiencies or seek clarification on specific matters. Clarifications or additional documentation may be requested from the engagement team to address review findings. Once the review is complete, the reviewer may sign off on the documentation, indicating that it has been reviewed and is deemed satisfactory. This sign-off is often documented within the audit file. The audit documentation review is a crucial step to ensure that the audit work is of high quality, follows established procedures, and is well supported. It adds an additional layer of assurances before the issuance of the audit report. The independent partner review is a further level of quality control conducted by a partner or senior member of the firm who is not part of the engagement team. This individual is independent of the audit being reviewed. The objective is to provide an independent and objective assessment of the overall quality of the audit engagement to ensure compliance with professional standards, firm policies, and regulatory requirements, and to confirm that the conclusions reached and the audit report to be issued are appropriate. Key aspects of the independent partner review include the reviewer is independent of the audit being reviewed, ensuring an unbiased and objective evaluation. The reviewer assesses the overall quality of the audit engagement, including risk assessment, audit procedures, and documentation. The review also includes a check for compliance with auditing standards, ethical requirements, and firm policies. The independent reviewer communicates with the engagement team to discuss findings, seek explanations, and address any concerns identified during the review. Any significant issues or matters requiring attention are discussed with the engagement team. Similar to audit documentation review, the independent reviewer may sign off on the documentation after confirming that the engagement meets the necessary quality standards. The independent partner review is a final and independent check to ensure that the audit engagement meets the highest quality standards. It provides additional confidence to the firm and stakeholders that the audit work has been conducted in accordance with professional and ethical standards.